Hey guys, Jack here. Today we're going to be discussing which is exactly better, investing in rental properties directly or investing in REITs. Now if you don't know what a REIT is, it stands for Real Estate Investment Trust. It's essentially a company listed on the stock market which is designed to hold properties on your behalf. In return of holding shares in a REIT, you can expect a dividend sometimes between 2 to 5%. Now this dividend payment made to you is derived from rental properties directly or property related income, so selling and buying assets. The dividend, like a share, is paid normally every quarter. However, in some REITs, you can actually get a dividend every single month. For example, the Realty Income REIT, which is a REIT in America, gives its dividend every single month. So it's almost like you're actually owning a property when collecting rent every single month. By owning a REIT, you can sometimes also benefit from capital appreciation, so i.e. real estate prices rising, causing the share prices to also go high because it actually holds the real estate on the back end. So it's almost in effect like owning a rental property, except it's not. There are several differences between owning a property and owning a REIT, and these differences is why some people actually prefer to own REITs over rental property and why some people like to just go in and straight own the property directly. Although none of what I'm about to say should be construed as financial advice by any means, we're going to be discussing these points and actually finding out which is the sort of best option for you. I'll also be discussing my personal strategy behind all this. The first point we have is capital requirements. How much money do we need to actually get involved in property? Well, if you wanted to invest in residential property in the UK, it will cost around £249,000. Now that's the average cost of a home in the UK. Now that's obviously an example. Obviously it's going to be differences in London and Brighton, but that's an average. Now to buy this property as a buy to let, which is when you're actually letting out and receiving rental income from tenants, you're going to need around a 25% deposit. With this example, this equates to around £62,000. So it's clear, it's a barrier to entry. Not everybody's going to have £62,000 to actually spend on a property investment. Now that's to buy one single freehold property. These numbers will obviously go up if you're looking to buy a commercial property or a block of flats, so keep that in mind. Now comparing this to REITs, the barrier to entry is quite small. In fact guys, there's actual REITs that cost just around £1 to own, and that means that even if you buy 100 shares, you can still benefit from capital appreciation and the dividend payment. Now it's not only upfront capital you need for a rental property, you also need to pass a affordability check. Usually you cannot borrow more than 4.9 times your income. Based on the average wage in the UK of £31,000, the average person cannot borrow above £160,000. Now that's just a box standard buy-to-let mortgage. If you want to do something more creative, like add value to a property, you're going to need to spend a lot of time actually learning the whole process. This can include understanding how refurbishments work and actually spotting a good property to refurbish. There's a whole lot of learning you got to do there. Now if you know how to do this stuff, then that's great, but if you're like me who doesn't know anything about refurbishments or building, then the REITs can be a better option because you're letting the management team behind the REIT do all the work. Now the next point we need to consider is control. Although the REIT will allow you to pick the place you want to invest in, so i.e. London or another part of the world, the sector you want to invest in, so offices or commercial or residential, is not going to allow you to actually pick out the exact property you want. So buying a house or a property directly will obviously give you more control. Now some people like that sort of control, but other people don't want to have that sort of option. They'd much rather have that option sort of taken away from them. With some REITs, you actually get an understanding of what actual assets the REIT holds. So you can go on the REIT's website and actually see what properties are listed there. But there is no way to actually vote that, I want my properties in sort of this area or that area. You have to let the management team do all the work. The next point we have is the level of passiveness. How hands-off is the entire investment? Now, before you actually own the physical property and the rent starts coming in, there's several steps you need to go through before you can even let that happen. One of the steps is actually finding the property you want in the first place. Let's say you found your favorite property on Rightmove. Then you have to get the real estate agents involved to actually arrange a viewing. Then you have to go through the mortgage process, which could take a couple of weeks at a minimum. And if the property you're interested in is in a chain, then it's a whole different story. A chain purchase is when the person you're actually buying your home from is actually finalizing their purchase of their home. If you're involved in a chain purchase, you have to wait until they sort of sort out their transaction, and then that's when your transaction can only go through. Now this process can take ages, especially if you come across a house which has multiple chains involved. Now compare this to REITs. You have to do your initial analysis, your initial research to find which REIT is most suitable for you. And then you sort of invest. You click a button on your app, on your Trading 212 app or free trade, link in the description for a free share. And that's it. So when looking at the initial process, the REIT has a little bit of a lead. However, the next point did change the game for me. But before we get into that, make sure you smash that like button and subscribe if you want to see more videos like this. Anyway, let's get back into it. Now we've discussed how strenuous it may be to actually buy a property in the first place. But how passive is your investment afterwards? Once you're in the deal, do you have to do much maintenance? Well, just going through some property forums will tell you the difficulties and the headaches of being a landlord. It can be very difficult for a landlord when you're trying to, have a peace of mind, and your tenant calls in asking for, a boiler replacement or some other issue that came out of nowhere. Or what about on the odd chance, like you see on Can't Pay, We Take It Away, your tenant stops paying you rent. You have to go through the whole eviction process, which can be quite stressful and it will cost you money. Although money comes and goes, the time you have is the most valuable thing to you. Dealing with such issues eats away at that time, which you can't actually work on your skills, you can't work on growing your income, let alone this whole process eating away at your investment. It can be very, very strenuous and difficult to recover lost rents from bad tenants. And waiting for the old tenant to move out and the new tenant to move in also eats away at your rental yield. So for the whole passiveness, hands-off category, I would say REIT wins out of this as well. Because once you've hit that buy button, it's pretty much on autopilot. Yes, you might want to check the stock price here and there because that's what we all do in the end. But if your fundamentals of the REIT are good and you're investing for the long term, then you're less likely to do that as well. Now this brings me on to my next point, which is quite important. Diversification. If you invested in a bog standard buy to let, you're either going to have 0% occupancy or 100% occupancy. There are several risks to consider if you're just buying one single property, i.e. the tenant could stop paying rent, or the area you chose your property in has a downward trend. This can have a massive hit on your rental yield and your appreciation. Now we haven't seen much of the appreciation side going down because in the UK, house prices seem to just keep rising. But you do risk a legislation coming in that it makes it much harder to be an effective landlord, like we've seen with HMOs increasingly. Only existing landlords will tell you how legislation coming in has affected the buy-to-let market, although sometimes these legislations are good because it's for health and safety. Other times it can just eat away at your rental profits. Now the diversification risk only impacts you if you have one single property in one single country. Now if you have multiple properties scattered around the UK or indeed abroad, then your diversification can be quite good. Now this is where I found out that REITs outperform direct property investment. This is because by holding one REIT, you can take advantage of a huge amount of diversification. Some REITs hold thousands of properties, have thousands of tenants, so you're very well diversified. If one property has an issue, then you have all the rest of the 999 properties able to actually serve you that dividend payment. For example, the Realty Income REIT has a diversification of 6,500 plus properties in over 49 different states and in the UK. Now to diversify even more, you can also find REITs that diversify and split your pound investment across multiple different REITs, which can mean you're splitting your pound into thousands of different properties across hundreds of different sectors. And REITs also make it easy to invest in different properties in all around the world. However, things really do change when it comes to taxes. In the UK, if you hold a REIT in an ISA investment account, they are tax-free. Unlike a regular company, the REIT itself is exempt from corporation tax, which means there's more money they're investing in acquiring properties and potentially more money trickling down to you in the form of dividends. But as well as this, if you hold a REIT inside of an ISA, you don't pay any taxes when you sell the REITs or when you collect the dividend payment, which leaves you more money to invest, withdraw, or do whatever. Now with physical property investment, it can get quite complicated, so make sure you speak to a qualified accountant if you want more information. But just as an overview, if you own a property, you'll receive rental income. Now the profits behind the rental income will actually be subject to corporation tax if you're holding that property within a limited company. Holding a property in a limited company is what most landlords are doing nowadays because of legislation. However, if you're not willing to do that, you can hold it directly on your name, but then you'll be subject to income tax depending on your income grade. So from a tax standpoint, REITs are better because paying no tax and investing that income which you otherwise would have had to lose because of tax is better than paying tax. But what about liquidity? What if you come in a scenario where you're going to need that money and you need to sell off your investments? Now with a property, you're going to have to go through the whole listing process, and it could take as much time as it took to actually buy the property in the first place. It can literally take months before the property you have is sold and the money hits your account. Obviously it depends on the demand of the market, but with REITs, obviously you can actually sell them quite quickly by literally hitting the sell button. However, with all these things in mind, there could be one thing that makes direct property investment a better option, and that is leverage. Property investment allows you to borrow money to invest. You can potentially borrow 75% of the value of the property. This means that any appreciation you do receive is going to be more because you're borrowing money to invest. So you're investing more than you're actually depositing. With REITs or shares, there is not a safe way in the UK, in my opinion, that you can actually get leverage. So in my opinion, if you're knowledgeable about property and you can potentially spot a good deal, a fixer-upper where you can actually add value, then maybe property is a better option. However, if you're like me and you don't want to be dealing with tenants, don't really have the capital requirements, want that good diversification, and wants that hands-off approach, then maybe REITs are a better investment. But having said that, I would definitely change my strategy throughout my life once I have more capital available to actually invest. If you're thinking about investing in REITs, then make sure you check out my video here where I discuss my top 4 REIT investment. But as always, if you like this video and you found it informative, please drop a like and subscribe if you want to see more videos like this. But anyways, thank you so much for watching, and I'll see you in the next video.